Our asset allocation committee recently decided to rebalance some money out of stocks, which look less attractive after a strong rebound since the lows of last March. Our measures of investor sentiment are flashing red, meaning investors may be overly optimistic on the markets. As we often do, we want to follow the general market principle of buying low and selling high. This means we now have a modest underweight to equities relative to bonds and cash. But I want to clarify what we mean when we say we've moved underweight stocks. Sometimes when I talk in the media about underweighting stocks, the headline becomes that we don't like stocks. The misleading implication is that we're telling investors to get out of stocks completely. That's absolutely not the case. First, this is the view of our asset allocation committee. We don't have a house view at T. Rowe. We value a diversity of opinions. My colleagues running our equity strategies are highly skilled at what they do, and they're finding opportunities in stocks across the investing universe. Second, this is an incremental move to underweight. As an example, if we were looking at a 60-40 portfolio of stocks and bonds, we would consider reducing the stock allocation by a small amount, say 1 percentage point, to invest the proceeds in cash or low duration tips, in other words, in dry powder. As one of my fellow asset allocation committee members put it, this is the art of gliding down risk, if you will, in aiming to be less vulnerable to a sell-off. As asset allocators with a 6 to 18-month horizon, we still believe in the recovery trade, mainly through relative value positions. For example, value versus growth, small versus large, bank loans versus investment-grade bonds, and emerging markets versus developed markets stocks. Rising interest rates, higher inflation, and positive economic growth could boost value stocks further, while the shortage of vaccine supply is a headwind for emerging markets. These regions have greater exposure to value-oriented cyclical sectors like financials and industrial, which might benefit as economies fully reopen. In other words, we're looking to find the best spots to participate in an economic acceleration caused by the reopening and massive stimulus measures. We believe that the macroeconomic environment remains strong and earnings could continue to surprise on the upside. As I often say in these videos, I believe in the importance of staying invested and staying diversified. Thank you.